Next question says, why is a high-quality bond typically considered a lower risk investment than a stock? A says that stocks are stable and do not change often, and that's not true. Stocks change the most often. B says a bond typically pays a fixed, predictable amount of interest each year. That's true. 3 says bonds are issued by many different entities. That's also true. And 4 says well-established company stocks pay dividends to their investors. That is true. So of all of these, B, C, and D are all true. A is not true. Stocks are not stable. Stocks are very volatile, and they're considered very risky investments. The reason they're considered riskier is because they're volatile, and they do change often. Bonds, I think it's important to understand what a bond is. A bond means you hold debt, and this is different from stocks, which means you hold equity. When you buy a bond, what you're essentially doing is you're loaning money to the bond issuer. And after a certain amount of time, the bond issuer promises to pay you back, and they also pay you interest on your loan. A stock, on the other hand, means that you've bought a share of the company, and so you are entitled to a share of the profits, which is what some companies will pay back to you in dividends. And in other cases, what it really means is that when the value of the company goes up, your stock increases in value, and so your equity is worth more. And that's how you make money off stocks normally. Your price of the stock goes up, and you sell it to somebody else. And so the reason that we think that bonds are lower risk is because holding debt is better than holding equity. Holding debt means that the company has a primary obligation to pay back the debt that it owes before it pays back anything in equity. And so that's going to be the main reason we consider bonds lower risk. And part of that low risk is tied to this fixed, predictable amount of interest every single year. You will be paid this interest on your loan, even if most likely the company goes bankrupt. And so that fixed amount of return on investment is going to make bonds a lower risk investment compared to stocks, which are going to be volatile. And so B is going to be the best answer here. A high-quality bond is typically considered a lower risk investment than a stock because a bond typically pays a fixed, predictable amount of interest every single year. Okay, so let's take a look at the previous tutor's answer. The previous tutor says that stock is showing a fractional ownership of the company. It means if a person has some stock of a company, then that person has proportional ownership of that company. The bond, on the other side, is a type of debt instrument, and the company needs to give preference to the bond holders over equity holders. It is because of this reason that the company owns debt from a person, owned debt from a person, which is a type of legal loan, and the company is liable to pay them back, which is not in the case of a stock. And they say that high-quality bonds are typically considered a lower risk investment than a stock, therefore option B is the correct answer. Right, and so some would also argue that a guaranteed regular return on investment is a lower risk investment compared to a volatile one like stocks. So the solution is correct, and we can move on to the next answer.